financial management. This is the topics to be covered. What are the topics to be covered? It is first time and introduction to financial management and time value of money. Then we will discuss capital structure theories. Then we will discuss cost of capital. Then dividend policy, leverage analysis, capital budgeting, working capital management, ratio analysis, fund flow statement and cash flow statement. This is the order in which I will take up the topics for discussion. This will cover your entire syllabus. Okay. Today we will discuss the introduction to financial management and the concept of time value of money. Now, what is the concept of financial management? Please understand. Can everybody understand Tamil? So that I can keep the class multilingual and more understandable and interactive. Is there anybody who cannot understand Tamil? Okay, fine. What is financial management? Financial management அப்படிங்கிறது management of finance. Finance na enna? Finance na money. Right? So the financial management is related to management of finance. What is finance? Finance is nothing but money. The financial management, fine, okay. I am telling in English now. The financial management starts from home to big industries, right? So at home, if you are all unmarried, your mom will take care of your finance activities. And if you are married, you yourself will take care of finance activities for the home. So we create a budget. I'm married, I'm 40 years old. So I create a budget for every month that I have to spend so much of money for the month. And then I prepare a budget. After I prepare a budget, I ask for money from my husband and I spend it. Later, when there is a necessity at the later end of the month, I further call for money, right? So what am I trying to tell you about financial management? Financial management is nothing but management of finance. It starts from home to big businesses and industries. What is the objective of financial management, right? We know what is financial management, which is nothing but management of finance. So what is your objective of sitting in my class? To learn the subject. Then what is the objective of doing financial management? By doing financial management, there are two purposes or two objectives. One is profit maximization and the other is wealth maximization. What do you mean by profit maximization? It is maximization of profits. So if I am in a business organization, if I am having my own business, and if I am a startup organization, if I am a startup organization, I cannot expect huge amount of profits in the starting itself. In which case, I will at the initial stage work for break-even. Break-even is no profit, no loss. At the initial stages, I will work for break-even. And later, as I progress in my business, I will aim for profits. After I aim for profits, what will be my next step? With the profits, I will create wealth. So, for example, if I am running a business, for running a business, I have invested some capital. With that capital, I am making some profits this year. Okay, I am running my business, whatever might be the business, be it an educational institution itself. I am running a business in a rented premises. So, as of now, I am making some profits. That profits, I can use it in two ways. One is reinvest into the business, develop the infrastructural facilities which is available. Or the premises for which I am paying rent, that can be saved by buying the building or by buying the premises in which I want to conduct my classes. So what is happening? With profits, you can reinvest the money into business, or you can with profits. What is the objective? I do not know why my voice is lagging. I'm having full network here. Please check your networks. Okay. So the financial management is nothing but management of finance. That management of finance starts from home until, just a minute. Why is everyone telling about unstable? Just a minute. Now is it clear? Now is it clear? Okay. Okay. So, what am I trying to tell you? Financial management is management of business. Where is it applicable? It is applicable right from home to big businesses. When you start up a business, you invest capital and start the organization. With that capital, you will make profits. So, at the first step, it will be, I cannot handle in two languages. I will make the English understandable. Because there were a few saying that Tamil cannot be understood by them. Okay. So, with the money which is invested into the business, which is the form of capital, later, what will happen is that capital will be reinvested into the business. So, I was giving an example of an educational institution run by me. So, if I am running an educational institution, I can develop with the capital I have invested, I have started my educational institution. Later, I can develop it by establishing more on by investing more on infrastructural facilities, or the premises in which I am taking classes, it is on rental basis. Just excuse me, it is on rental basis. So that premises I can buy. When I'm going to buy a premises, it becomes an asset creation. So what am I trying to convey here? The objective of financial management is profit maximization in the short run and wealth maximization in the long run. Best example is Reliance Industries. Reliance Industries started with that 500 rupees mobile phone. Okay, I qualified a CMA in 2007, right? And I'm a member of the institute now. I've been in teaching since the time I cleared CMA, right? So what am I trying to convey is that small 500 rupees mobile phone sold by Reliance only was my first mobile. 500 rupees, it has a SIM inserted in it. It has a SIM inscribed in it. Okay. It had a SIM. Now that mobile has become redundant. So the Reliance Industries started with capital investment. They made profits in the short run. And now they are the richest people in the world. So they have developed wealth maximization over the long run. So in the short run, the objective of financial management is profit maximization, and in the longer run, it is wealth maximization. So what is financial management? It is management of finance. What are the objectives of financial management, or what is the purpose of financial management? It is profit maximization and wealth maximization. Now coming to the core concept of the subject, time value of money. What is this time value of money? Suppose if you are required to pay me or 10,000 rupees, just an example, okay? Or if I have to pay you 10,000, like we will keep it this way. I have to pay 10,000 rupees by the month end. Today is February, some date, February 18th. Okay. By February 20th, I am supposed to pay you 10,000 rupees. Okay. And I also give you one more alternative, that I will pay you the same 10,000 after 1 month. Next month 18th. Instead of this month 18th, I say, can you give me 1 more month's time? I ask you, I will pay by March 18th. Will you agree? Not because it is Priya ma'am. Now I am coming to the concept of time value of money. If somebody has to give you money, and if they say, I will give you money 1 month later, but the same amount, will you agree? If yes, why? If no, why? No, why? Yes, exactly. That's the concept of time value of money. If I get 10,000 rupees today, I can invest it immediately and make some returns. If I'm going to get the same amount of money at a later time, I will not accept, because there is a concept of time value of money. With passage of time, the value of money will go down. What does it mean? 10,000 rupees today, 1 month later will be worth 11,000 rupees. Suppose 1,000 is interest per month. Okay, 10,000 rupees today will be 11,000 next month. But the other party says, I will pay the same 10,000 next month, which means what is happening to that value of 10,000? That value of 10,000 becomes 11,000 in the next month. So 1,000 becomes, yes, 1,000 becomes loss for us. So the value of money, which money? The same 10,000. Value of 10,000 is not the same from period to period. That is what is the concept of time value of money, right? So after the concept of time value of money, which is the basic for financial management, later we will analyze on how effectively does an organization manage its finance. I am just trying to explain the syllabus to you in a logical format. Every business will start with capital, correct? That capital can be either own funds or borrowed funds. How much of own funds, how much of borrowed funds depends from one company to another. If I have sufficient resource, I will invest all my resources. If I do not have sufficient resource, I will have to borrow. In such case, the borrower is called as debt and own funds is called as equity. So, what composition of debt and equity will optimize the capital structure is what we will study. So, how should the capital structure of an organization be framed? Should the capital structure of the firm be 100% equity, or should it be 100% debt, or should it be a combination of debt and equity? Own capital is equity. So that is what is called as capital structure analysis. This capital structure analysis has led to development of various theories by various economists, financial management economists, who have suggested various theories for the proper mix of debt and equity, for the proper composition of equity and debt in the capital structure. So that is what we will study in capital structure theories. Next, for whatever is the capital invested, capital is the money which is invested in the business, and business is a separate legal entity compared to the proprietor, right? If it is not a sole proprietary concern which I am talking of, no, debt is not preference capital. So we once when the capital is comprised, there is a cost associated to the capital. Cost for whom? Cost for the company. Company is a separate legal entity compared to the owner of the company, right? So in such case, for the capital which is invested in the business, capital is shown on the liability side, which means it is a borrower for the company, which means the company has to pay some dividend for shares and interest for debt. So in such case, that dividend or that interest is what is called as cost of capital. It is cost to the company but return to the investors. How are we going to find the cost of capital to the company? If it is cost of equity or cost of preference share capital or cost of debentures, we will find it using cost of capital. Later comes dividend policy. Okay, fine. I understood that I have to pay some dividend to the shareholders. How much of dividend should I pay? Should I pay 100% of income as dividend to the shareholders? Or should I pay a portion of dividend to the shareholders and reinvest the remaining profits back into the company? Because the shareholders are the owners of the company. So they are concerned about the progress of the company. In such case, the entire profits will not be distributed as dividend. Not always. Sometimes entire profits will be distributed. Sometimes what will happen is a portion will be reinvested into the business. So under dividend policy, we will discuss how much of profits is to be invested in the company, how much of profits has to be declared as dividend. That is under dividend policy. Next comes leverage analysis. Leverage is a measure, is a ratio. Leverage is a ratio. Leverage is a measure for what? To find the impact of fixed cost on profits of the organization. So the fixed cost can be classified into fixed financial cost and fixed operating cost. So during the operations of the organization will incur a lot of fixed cost. Rent of the premises, depreciation of the asset. All those are examples of fixed cost. Those are fixed operating cost. Then we have fixed financial cost with no salary is payable is also fixed cost. Then we have certain fixed cost with respect to financial aspect. I told fixed cost are of two types. One is fixed operating cost and the other is fixed financial cost. What is fixed financial cost? It is interest on debt. Okay. So fixed financial cost is interest on debt. How is that fixed cost going to influence my profits? Is what we will study under leverage analysis. What am I going to do with leverage analysis? I would be finding the fixed cost will remain constant. What is the nature of fixed cost? It will remain constant irrespective of change in the sales or production. Right. So when the volume is more, the fixed cost will seem to be low. Correct? Suppose if the volume is 1 lakh, sales is 1 lakh rupees. The profit made by the organization is 50,000 rupees after various cost, and fixed cost is just an example, all random numbers. Fixed cost is 20,000 rupees. 1 lakh was sales, 20,000 was fixed cost, 50,000 was profit. Nadula, there will be some variable cost. So just ignore the variable cost because of this example. Why? Because I am talking about the impact of fixed cost on profits made by the organization. I am not bothered about variable cost. What will happen when sales become 1,20,000? Fixed cost is not going to change. It will remain the same 20,000. But the profit will increase. With increase in volume, profit will increase, but fixed cost will remain same. So, higher the volume, fixed cost will appear to be small. For 1 lakh, if 20,000 is fixed cost, it is 20%. But for 10 lakhs of sale, 20,000 of fixed cost will be only 2%, correct? So, higher the volume, the fixed cost will look smaller. If you are traveling in an aeroplane, higher the extent you fly, what will happen? Everything will look small to you on earth, right? So, what am I trying to convey? I am trying to convey the leverage analysis helps to measure the impact of fixed cost on profits. It need not necessarily be higher every time. What if the sales are going to fall down? If the sales are going to fall down from 1 lakh to 80,000, the fixed cost of 20,000 will remain the same, and there the fixed cost will look like a burden. The fixed cost will look more compared to the sales, correct? So such impact of fixed cost on profits is what is called as leverage analysis. So until the first 5 topics, it is how the capital is going to be raised, then what is the cost which I am going to give, and what is the impact of fixed cost. After that, what am I going to do? I have raised money for the business. I am bothered about profits, because only then I can give dividend, only then I can give interest. I can find everything only after I find profits. So now what am I going to do with the capital raised? I have to invest it into the business. எனக்கு என்ன பண்றதுன்னு தெரியலம்மா, எனக்கு இங்க full tower இருக்கு, ஆனா ஏன் breaking தெரியலையே. With the money raised, what am I going to do? I am going to invest it into business. How am I going to invest it into the business? I will invest it into the business into long-term investments and short-term investments. Not every money I will invest in long-term capital, correct? So, the money which is raised as capital, I will invest in long-term and in short-term. But such investment I will do not blindfoldedly. Now, just like that, தூக்கி ஒரு machinery ல பைசா போட மாட்டேன். Just like that, I will not invest in a particular asset without evaluating the feasibility of the project. So, in such case, I will have to evaluate whether I can invest in a particular machinery or not, whether I can invest in a particular software or not. Such evaluations, long-term investment decisions, long-term investment decisions are evaluated using the tool of capital budgeting. Just by investing in machinery, will it run on its own? I have invested 10 lakhs in machinery, ma. Will it run on its own? Or do you need raw materials? You need raw materials. If I give raw materials again, will it run on its own? I need some laborer to handle such raw materials, correct? At least to feed it into the machinery. Then, just with raw material and labor, will the machine run on its own? I need power for running the machinery. So, I need to invest for operational activities of the machinery. I need to invest for operational activities of the particular project. So, such investment is what is called as working capital. Working capital is investment in current assets minus current liabilities. And how much should I invest in such working capital is what we will study using working capital management. Now, again, let me tell you, under financial management, an organization first raises its capital. Whether it should be debt or equity, I evaluate using capital structure theories. Later, I decide on the cost which is to be given to the shareholders as cost of equity, cost to preference shareholders as cost of preference capital, cost of debt as cost to the debenture holders. After that, I decide on how much of profit should be declared as dividend to the shareholders. Then I measure the impact of fixed cost on profits made by the organization. To make such profit itself, I have to invest the capital into the projects. So how effectively will I invest the capital into projects? I will invest in long term and short term. How much in long term and how much in short term? Such evaluation will be based on capital budgeting and working capital management. Capital budgeting helps us to evaluate long-term investment decisions. Working capital management helps us to evaluate short-term investment decisions. Later, the start of the year 2022 has been a good year. So I have started this year, January, with investing capital into my business. On December 2022, what should I do? I have to prepare my financial statements. I have to present an annual report to the shareholders of the company. Under such case, the presentation of financial statements under financial management takes three forms. One is ratio analysis, the other is fund flow statement, and finally cash flow statement. So the forms of presentation of financial statements is what is also known as ratio analysis, fund flow statement, and cash flow statement. Leverage analysis is also, is it? No. Leverage analysis is different, ratio analysis is different. Leverage analysis measures only impact of fixed cost. Ratio analysis, we establish ratios wherever possible. I'll explain it in detail when we come to that particular topic. So, ratio analysis, fund flow statement, and cash flow statement are the forms of presentation of financial statements at the end of the financial year for submitting a report to the investors in the company. The investors in the company need not only be shareholders. It can be the creditors, it can be the lenders, it can be the debenture holders, it can be the interested parties in the company, the management, it can be the interested parties in the company, the prospective investors, and everybody. Is the subject of financial management. I've just given an overview. Is the overview clear to everybody? Fine. Now let's move on to the concept. Coming to the concept of time value of money first. Telegram chanting, I do not have, I'm not an admin also. So I was added in the group just like any of you there. Telegram channel name is CMA Inter June 2022 term. Okay. Now, coming to the concept of time value of money. What is this concept? I told you. With passage of time, the value of money will go down. So, how are we going to find that time value of money. That value of money I can classify into two forms. One is can everyone hear me? எனக்கு இங்க ஃபுல் டவர் இருக்குமா? நான் மோடம் பக்கத்திலே உட்காந்துருக்கேன். Right. So, coming to the concept of time value of money. Time value of money can be classified into two forms. Please look at the cursor movement. Okay. Time value of money can be classified into two forms, which is the present value of future money and the future value of present money. I told you, 10,000 rupees today or 10,000 rupees 1 month later. So, if I get 10,000 rupees today, what will I do? I will make an investment in some investment. In such case, I will get some return. What is the return? There are two concepts of return. You should have studied it at school level: simple interest and compound interest. But simple interest has become redundant. It is no longer applicable. Everywhere it is only compound interest. What is interest formula? A is equal to P into 1 plus R to the power of N, where P is the principal, R is the rate of interest, N is the period, and A is the return on investment. Whatever is the money invested is going to give me A as return, including interest. Correct? So A is equal to P into 1 plus R to the power of N is the compound interest formula, which you should have studied from your school level itself. Suppose if I have 10,000 today, at the end of the period, at a particular rate of interest and for n number of years, 1 year, 2 year, 3 years or whatever, I will get a return, which is A. This A is what is called as the future value of money. Why am I calling it as the future value of money? Because that A I am not going to receive immediately. That A, suppose if I am making an investment for 1 year, that A I will receive after 1 year only. In such case, A is called the future value of money or the money which I will receive on maturity of investment. Okay. So, knowing A being the future value of money, P being the present value of money. Present value of money is the principal that is invested. How will I find the other way? How do I find the present value of money then if I am given A? If I am told that at the end of 1 year, the maturity value of my investment will be 1,10,000. How much of principal should I invest today? If question is asked. Let me repeat the question. If the maturity value of investment at the end of 1 year is 1,10,000 at a particular rate of interest, how much should be the principal invested today? If such is the question. In such case, I will have to find the P. How do I find P? P can be found as A. Excuse me. P can be found as A divided by 1 plus R to the power of n. It is simple cross multiplication. 1 plus R to the power of n, which is multiplied here, I bring it to the denominator. Now, what am I going to find? I am going to find P. What is P? P is the principal. What is that principal? It is the money invested today, which is the present value of me. Are you able to understand this simple formula? If they are asking you future value, it is A is equal to P into 1 plus R to the power of n. If they are asking you for present value of a future money, P is equal to A divided by 1 plus R to the power of n. Is the concept clear? Did you understand? Hello, could you understand? Hear me? Do you understand? Okay. So after this, what am I going to do? I'm going to get into the next concept. Next concept is A is equal to P into 1 plus R per N. That was the basic formula. Na? That is when the compounding is done once in a year. If the compounding is done multiple times in a year, you have you heard of return from video? I can't help it, ma'am. எனக்கு இங்க full tower இருக்கு. நீங்க பாருங்க கொஞ்சம். See, why is the screen not clear? Next question. Now can you all see? Now can you all see the screen? Fine. Right. Now, in case of multiple compounding, what do you mean by multiple compounding? Have you all heard bank deposits which provides quarterly interest, half yearly interest, monthly interest? Have you heard? Bank deposits providing quarterly interest, monthly interest, half yearly interest. In such case, it is called as multiple compounding, where the compounding takes multiple times during the period. Suppose if the investment is for 1 year, instead of receiving interest at the end of the year, I want to receive interest every month. In such case, that is called as multiple compounding. How would I find the future value in case of multiple compounding? I will apply the formula A is equal to P into 1 plus R by M to the power of Mn, where M is the number of compoundings. What is this M? M is the number of compoundings. I do not understand. 1 minute. 1 minute, just give me some time. A is equal to P into 1 plus R by M to the power of Mn. A is equal to P into 1 plus R to the power of N is the basic formula. Okay. A is equal to P into 1 plus R to the power of N is the basic formula. So, I can't really help it. நான் இந்த full tower பக்கத்திலே உட்கார்ந்துட்டு இருக்கேன் மோடம் பக்கத்துல. இப்ப கேக்குறதா? இப்ப கிளியரா கேக்குறதா? Okay. Right. So, in case of multiple compoundings, yeah, that's what I'm telling. For others, you people are having network issues probably. Right. In case of multiple compounding, the formula takes a revision. The formula is subject to a little change. What is that change? A is equal to P into 1 plus R by M to the power of Mn. What is that M? M is the number of compoundings. Suppose if they say the investment of 1 lakh is at 10% for a year. Okay. So, if the investment is 1 lakh for 10% of interest, which means the return at the end of 1 year will be 1 lakh and 10,000. But the investor says, I do not want interest at the end of the period. Instead, I want interest at the end of every month. In such case, the maturity value will be found using the formula A is equal to P into not 1 plus R to the power of N, but 1 plus R by M to the power of Mn. What is that M? That M is the number of compoundings. If the investor wants return at the end of every month, it will be 12 times of compounding. If the investor wants return at the end of every quarter, it will be 4 times of compounding. How many quarters in a year? 4 quarters. And then if the investor wants return every half year, it means M will be 2. What am I trying to say? Based on how the investor wants a return, it will be subject to multiple compoundings. If the investor wants return only once in a year, the formula will be A is equal to P into 1 plus R to the power of N. But if the investor wants a return every month or every quarter or every half year or every week, in such case, the formula for finding the future value will be A is equal to P into 1 plus R by M to the power of Mn. What is that M? That M is the number of compoundings. If the investor wants a return every month, M will be 12. If he wants a return every quarter, M will be 4. Why 4? 4 quarters in a year. Why 12? 12 months in a year. If he wants a return, excuse me. If the investor wants a return every week, M will be 52 because there are 52 weeks in a year. If the investor wants a return half yearly, there are 2 half years in 1 year. So M will be 2. So that M will be based on how the investor wants his returns. These are the 2 formulae for a lump sum investment. If straight away I am going to go to a bank and invest 1 lakh into a fixed deposit for a particular period, they will ask you, how do you want your returns? Do you want it as a monthly return or an annual return or half yearly return or quarterly return? They will ask you. So this formula, these 2 formulae is for one-time investment. But have you all heard banks providing you recurring deposits? If I have to invest a certain amount regularly into the deposit, in case of a recurring deposit, in such case, such investment is called an annuity. When an investment is made multiple number of times, I am not talking about the returns. I am talking about the investment itself. When the investment is made multiple times during the investment period, the investment period, suppose if it is 1 year, and if I choose to make a recurring deposit every month, the gold chip schemes, right? In such case, how is the maturity value determined? The maturity value is determined using the formula A is equal to P into 1 plus R to the power of N minus 1 divided by R. So the basic formula was A is equal to P into 1 plus R to the power of N, right? But if the investment is made multiple times in a year, such investment is called an annuity. In such case, how do I find the maturity value of annuity? The maturity value of annuity is found as A is equal to P into 1 plus R to the power of N minus 1 divided by R. Here again, if I want a return with multiple compoundings. What do you mean by return with multiple compoundings? If I do not want a return at the end of the period, but I want it every month or every quarter or whatever, in such case, the formula will take a revision as P into 1 plus R by M to the power of Mn minus 1 divided by R by M. So how do I remember this formula? Wherever it is R, it is divided by M. In the numerator, there is an R. Here again, it is R. It is divided by M. Here again, there is an R. There also, I write it as R by M. And wherever there is an N, N is the period. Wherever there is an N, multiply it with M. So this will give you the return for a recurring deposit. R means rate of interest. Then comes the effective rate of interest. What is this effective rate of interest? The formula is 1 plus R by M to the power of M and minus 1. So let me give you an example. I have invested 1 lakh in a fixed deposit, and let me tell you that I want returns every month, every half yearly. Just an example. Okay. So 1 lakh is the money invested in a particular deposit for a period of 1 year at 10% rate of interest. If I am going to get the return at the end of 1 year, how much will be my return? It will be 1 lakh and 10,000. How 1 lakh and 10,000? 1 lakh invested today at 10% for 1 year, which means 10,000 will be the return. 1 lakh plus 10,000, 1,10,000 will be the money collected at the end of the period. When will it be 1,10,000? When I want the return only at the end of the year. But in case if I want return every half yearly, if I want return every half yearly, suppose I have invested that 1 lakh in January. Just an example. If I have invested 1 lakh in January, by the end of June, I will have to pay interest. Who? Bank. Why? Because the investor wants half yearly return. So at the end of June, I will have to pay interest. Again, at the end of December, I will have to pay interest. How much will I pay interest? 10% is the interest rate per annum, which means until June, the interest rate will be only 5%, which means on 1 lakh, if I apply 5%, I will get 5,000 as return. That 5,000 I will pay the investor by the end of June. Later, for the remaining 6 months, how much will be my return? I am talking about compounding here. How much will be my return? My return will be 5%. On how much? Not on 1 lakh, but on 1 lakh and 5,000. Why? Because the value of investment of 1 lakh by the end of June has become 1 lakh 5,000, which means from June or from July 1st to December 31st, I will again calculate the remaining 5% return, but not on 1 lakh, but on 1 lakh and 5,000. So effectively what will happen? Your study note only. First chapter, Introduction to Financial Management. So these formulae are not in your textbook. You can follow the textbook when I tell you. For now, please follow the screen. So I gave you an example of 1 lakh of investment. With that 1 lakh of investment, if suppose 10% is the rate of interest at the end of the year. Okay, 1 lakh into 10%, 10,000 will be the return. The maturity value will be 1 lakh and 10,000. Now, an investor comes and says, no, I want return every 6 months. In such case, at the end of 6th month, at the end of June 30th, I will have to pay 5% return. Why 5%? 10% is per annum, which means for 6 months it is only 5%. So 1 lakh into 5% will give me 1 lakh and 5,000. Correct? Later, 1 lakh into 5%, 5,000. 5,000 will be the interest, right? So from July 1st to June 30th, I have calculated interest of 5,000, which means how much will be the value of investment on June 30th? Value of investment on June 30th will be 1 lakh and 5,000. The value on June 30th will be the same value on July 1st. So from July 1st to December 31st, again I will have to pay the remaining 5% interest. For that remaining 5% interest, on what will I find? I will not find it on 1 lakh. I will find it on the value as on the date of investment. It is 1 lakh and 5,000. So 1 lakh 5,000 into 5% will give you 11,250. Correct? No, 5,250. 1 lakh 5,000 into 5% will give you 5,250. So if you total up the interest, how much is the interest at the end of the year? For the first 6 months, it was 5,000. For the remaining 6 months, it was 5,250, which means your total interest is 10,250. How much was the interest rate? 10%. 10% on 1 lakh is 10,000. But how much are you actually receiving? You are receiving 10,250. Why are you receiving that additional 250 rupees? Because of multiple compoundings, which means what will happen to your effective rate of interest? Your effective rate of interest will be 10.25% and not 10%. Now, are you able to understand what I am trying to convey? 1 lakh invested on January 1st. On June 30th, I will pay 5% interest, which will be 5,000 rupees. So 1 lakh 5,000 will be the value of investment on June 30th. For the remaining 6 months, I will find 5% interest on 1 lakh 5,000, which will be 5,250. So how much is the total interest at the end of the period? It will be 10,250. How much is the amount invested? 1 lakh at the beginning of the year, which means how much is the effective rate of interest? It is 10.25% compared to 10% which was told to us. Why am I getting that extra 0.25%? It is because of multiple compoundings. So that is the benefit of multiple compoundings. How am I going to find this effective rate of interest? This is the formula. I told you the logic. First 6 months it is 5,000. The remaining 6 months it is 5,250. So total 10,250. So it is 10.25%. This is the logic. I can find it straight away also substituting in the formula. How much was the interest rate? 10%. How many times did I compound in a year? Twice. Why? Because it was half yearly. So 1 plus 0.1 divided by 2, which is 0.05. So 1 plus 0.05. How did I get 0.05? This is 10%. R is 10%, which is 0.1. 0.1 divided by 2 will be 0.05. So 1.05 to the power of 2. How much are you getting? 1.05 into 1.05. How much is the number? 1.05 into 1.05. How much is the number? Are you all finding? 1.1025 minus 1. It is 0.1025. If I have to write it as a percentage, it will be 10.25%. Now are you able to get it? That's all. Are you all able to understand? Just now I gave an example. We will do sums. Is it clear? Is the concept clear so far? I told about investment one time. How am I going to find the future value? Then how am I going to compound it multiple times in a year? Then I told about a recurring deposit, which is an annuity investment. For that annuity investment, I will find the value if it is compounded only once in a year and if it is compounded multiple times in a year. Effective rate of interest. This effective rate of interest is applicable in case of multiple compoundings, where the return will be more than the percentage quoted per annum. That's all. Okay. So we introduced you all to the concept of time value of money. What is the concept of time value of money? With passage of time, interest gets added to the principal which is on hand, and hence the future value of money will be of less importance when compared to the present value of money. So everything we have to take it to the present value to evaluate it. How? What is the compound interest formula? A is equal to P into 1 plus R to the power of N. What is this R? It is the rate of interest. P is the principal, N is the period for which the amount is invested, and A is the maturity value. Then how do you find the present value? This A is the maturity value, which is the future value. What is this P? This P is the principal or the present value of money. In case if they have given you the future value and they are asking you for the present value, how will you find it? It will be future value divided by 1 plus R to the power of N. What is future value? It is A. A divided by 1 plus R to the power of N will give you the present value of future money. Then moving on to the multiple compounding interest. When it is compounded multiple times during the period, where I told you the effective rate of interest also. I am just quickly taking a recap of what I told in the last class. So in case of multiple compounding, the formula will be A is equal to P into 1 plus R by M to the power of Mn, where M is the number of compoundings. Suppose if they say the interest is compounded half yearly, it means it is 2 times in a year. If they say the interest is compounded quarterly, it means it is 4 times in a year. So likewise, the number of compoundings will vary depending on the situation. This formula for A is equal to P into 1 plus R to the power of N and A is equal to P into 1 plus R by M to the power of Mn is applicable if the investment is made only one time, if the investment is a lump sum investment. Suppose the investment is made multiple times during the period in case of a recurring deposit. In such case, we call it an annuity. How do you find the maturity value of an annuity?
the formula will be A is equal to P into 1 plus R to the power of N minus 1 divided by R. Here again, if the interest is compounded multiple times, it is P into 1 plus R by M to the power of Mn minus 1 divided by R by M. In case if you are asking me, how do I remember this formula? Wherever there is R, divide it with M. Wherever there is N, multiply it with M. So these are the two formulae in case of a recurring deposit. Then what is that effective rate of interest? If the compounding is done multiple times in a year, I gave an example also last time. I remember giving an example. 1 lakh is deposited at 10% for a year, compounded semi-annually, where we arrived at 10.25% as the effective rate of interest. So what will happen in case of multiple compoundings? The effective rate of interest at the end of the period will be actually more than the quoted rate of interest. Suppose they say 10% per annum. In case 1 lakh is deposited and they say half yearly compounding, what will we do? 1 lakh, half year interest rate will be 5% only. So 1 lakh 5,000 will be the value on 30th of June. For the remaining 6 months, you will find interest of 5%, not on 1 lakh, but on 1 lakh and 5,000. Where did you get that 5,000? That 5,000 was the interest for the first 6 months. So 1 lakh into 5% for the remaining period will give you 5,250. 1 lakh 10,250 will be the total interest. Total returns, not interest, total returns. How much was the principal invested? It was 1 lakh, which means how much is returns? 10,250. If you are going to represent it as a percentage, it is 10.25%. What was the interest rate quoted? 10% per annum. But because of multiple compoundings, the effective rate of interest is actually more than 10%. How do you find it? It is 1 plus R by M to the power of M minus 1. So instead of numerically calculating it like 1 lakh, 10%, 6 months, 1 lakh 5,000, 10% for the remaining 6 months. So instead of doing all that, you can find the effective rate of interest by substituting the numbers in this formula straight away. So what is the formula? 1 plus R. What was the example I gave? R was 10%. So 1 plus 0.1. How many times of compounding I gave as an example? 2 times. Why? Because it is half yearly. There are 2 half years in 1 year. So it is 1 plus 0.1 divided by 2, which is 0.05. 1.05 to the power of M to the power of 2. So in your calculators, you can find 1.05 into 1.05. That will give you 1.1025 minus 1. So it is 0.1025, which is nothing but 10.25%. Last class, I stopped until effective rate of interest, correct? Did I stop until effective rate of interest in the last class? Hello? Right. Proceeding further. Coming to perpetual return. What do you mean by perpetual return? Have you all heard of companies issuing irredeemable shares and debentures? What do you mean by irredeemable? Irredeemable means it will not have any specific maturity period. Suppose if I am investing in company share capital, equity shares are generally irredeemable. It is marketable, but it is generally irredeemable. So what will happen? You will be the owner of the proprietor of the company until it gets into liquidation. Only when the organization gets into liquidation, all the debt will be settled, the assets will be realized, and later you will end up in receiving money, right? So the perpetuity, it means that there is no specific maturity period. You do not have any N, to be very specific. What was the formula? A is equal to P into 1 plus R to the power of N. That N is infinity. That N is not known to us. If it is 5 years or 10 years or 12 years, there is no maturity period as such. In such case, how do you find the present value? It is found as cash flows divided by R. What are the cash flows because of investing in equity? It will be dividend. What are the cash flows because of investing in bonds and debentures? It will be interest. So on whatever you are going to invest, from that you are going to get returns. And in case of irredeemability, you will have returns until its longevity. So it is cash flows divided by R. Then one more formula is when the cash flows are subject to growth. See, if I invest in bonds and debentures, they say 10% debentures. In such case, the interest on debentures is fixed at 10%. But what happens in case of investment in share capital? The shareholders are the owners of the company. They get a share of profits. Is that a fixed rate of dividend or is it a fluctuating rate of dividend? It would obviously be a fluctuating rate of dividend. More the profits, more will be the share given to the shareholders. So the dividend is not having a fixed return like bonds and debentures. So whenever I am investing in share capital, the organization will progress in its performance and later it will start giving more dividend to the shareholders. So in such case, earlier if it was giving you 10 rupees as dividend and later it is giving you 12 rupees as dividend, which means 2 rupees is the increase. That 2 rupees is because of the growth of the organization. So whenever they have given us the growth rate, the return to perpetuity will be cash flows divided by the rate minus growth. Whatever is the rate of return minus the growth rate. These two formulae, as of now, return to perpetuity and return subject to growth, these two formulae, as of now, we do not have sums. I will tell you as until then, you please remember these formulae. Is the concept clear? Shall we move on to sums? That's all with the formulae for this chapter. We will move on to sums. Please take your textbook. The introduction to financial management I gave in the previous class. Wonderful. You are asking which subject now? Financial management, cost management and financial management. The page number in these notes will not match because of the addition. The syllabus is same. Syllabus is 2016 only. But because of the addition, the page number will not match. But it's okay. You can follow the sums. I will guide you. Please take page number 238, illustration 1. Because of the addition, the page number will not match. Please take illustration 1, page number 238. Is it 238 in your books or the later editions may have a different page number as well? Please check. In the first lesson, Introduction to Financial Management, please take illustration 1. Have you all taken? Fine. What is told in this sum? Please follow. A person is required to pay annual payment of rupees 8,000 in his deposit account. That pays 10% per year. Find out the future value of annuity at the end of 5 years. So, how much is the principal that is deposited? Please follow the solution. How much is the principal that is deposited? It is 8,000. Are they going to deposit only one time or several times? They have told, please read the question carefully. A person is required to pay annual payment of 8,000 in his deposit account, which means this 8,000 is the principal which the individual is going to invest every year. So it is not a lump sum investment. One more identification that this is not a lump sum investment will be, they have told find out the future value of annuity. When will they use the word annuity? The word annuity will be used when the investment is made multiple times. Okay, so that is also one more indication that we have to apply the annuity formula. Right. How much is the principal? It is 8,000. They have told R as 10%. They have told the period as 5 years. With that, substitute in the formula. A is equal to P into 1 plus R to the power of N minus 1 divided by R. How much is A? It is 8,000. 1 plus what is R? 10%. 1 plus 0.1 to the power of 5 minus 1 divided by 0.1. Just simplify, you will get 48,841 by applying the value in the formula. Later you may ask me, ma'am, I forgot the formula in examination. How do I arrive at the answer? I will tell you, please follow your textbook. What is told in your textbook? At the end of 1 year, 2 year, 3 year, 4 years, and 5 years, please follow from your textbook. How much is the amount deposited? It is 8,000. It is a case of recurring deposit where the investment is made every year for a period of 5 years. So what will be the term of deposit? For the first year, if he is going to invest at year end, the money is deposited for a period of 4 years because first year is already over. So since first year is already over, the money will be deposited for a period of 4 years. If you are investing at the end of second year, the money will be deposited for a period of 3 years. Investing at the end of 3 years, the money will be deposited for 2 years. Then for 1 year. Then the money invested at the end of fifth year will not carry any interest because the maturity value is end of fifth year itself. So there is no term of deposit for the last installment. How do you find the future value? A is equal to P into 1 plus R to the power of N, correct? In case if you are not applying annuity, if I'm going to find it individually for every investment, how many investments have I made? I have made 5 investments. How did I know that? 5 years I have made. So for every year, find P into 1 plus R to the power of N. So for the first year investment, how did I get that 1.464 which is mentioned in your table? It is 1.10 to the power of 4. What is 1.10? It is 1 plus R. How much is R? It is 0.1. So 1 plus 0.1, which will give you 1.1. For what is the term of deposit? 4 years. So 1.1 to the power of 4. Multiply 1.1 4 times. You will get 1.464. Then it is 1.1 to the power of 3. Then 1.1 to the power of 2. 1.1 itself. Then for the last, anything to the power of 0 is 1. So it is 1 only. Add them up, you get the same 48,841. The table which is presented in your textbook is an elaborate presentation. They have also solved the formula. If you can see in the next page, they have also substituted in the formula and arrived at the same number. Suppose in your examination, if they are asking you this question, and if you are not able to recollect the formula, you can do it manually as well. If you are doing it manually also, you will get the same answer. 1 plus R, 1.1. A is equal to P into 1 plus R to the power of N, which is P is 8,000. 1 plus 10%. 10% is 10 by 100, which is 0.1. So you get 1.1. Is this sum clear? Is this sum clear to all? I will share the notes in the WhatsApp group at the end of the class. Is this sum clear? Fine. Please take the next sum. What is told in the next sum, illustration 2? I will do all illustrations and exercise. As regards financial management, I will solve every illustration and exercise sums. Now, ascertain the future value and compound interest of an amount of 75,000 at 8% compounded semi-annually for a period of 5 years. How much is the principal? 75,000. Like in the previous sum, have they told that 75,000 is invested every month or every quarter, every year? Have they told about the repetition of investment? One line question. Have they anywhere told about the repetition of investment? Ascertain the future value and compound interest of 75,000, which means it is a lump sum investment. So the principal is invested only once. It is not an annuity. That is the first inference from the question. The principal is 75,000. How much is the rate of interest? 8%. How is it compounded? Semi-annually, which means there is M coming into picture. Semi-annually, half yearly, which means it is 2 times in a year. So M is 2. What is the period of investment? N is 5 years. So how do you find the future value? Substitute the values in the formula. A is equal to P into 1 plus R by M to the power of Mn. 75,000 into 1 plus 0.08 divide by 2. Why 2? Compounded semi-annually to the power of Mn. So it is 1.04 to the power of 10. Just simplify those numbers. You will get 1,11,018 as the maturity value. They have not just asked that. They have asked ascertain the future value and compound interest. The future value is 1,11,018. How much is compound interest? It is the future value minus the principal that is deposited. So the difference will give you the amount of compound interest. Is this some clear? Is it clear to all? Fine. Please take exercise sums. Please take page number 242. Page number 242. Is it page number 242 where you have self-learning questions? In case if the page number doesn't match, please correct me. It's all dependent on the addition. It's okay. Ascertain the future value of 70,000 at 8% compounded semi-annually for 5 years. So that is point number 8. What is told? Ascertain the future value of how much? The principal is 70,000. How much is rate? It is 8%. If I have to represent it as a decimal, it is 0.08, 8 by 100. Then the period of investment N is 5 years. How many times is it compounded in a year? Semi-annually, which is half yearly. There M is 2. So A is equal to P into 1 plus R by M to the power of Mn. 70,000 into 1 plus 0.08 divided by 2 to the power of 2 into 5. 1.04 to the power of 10. So you get the maturity value or the future value. Is this some clear? Page number 242. Is this some clear to all? Fine. Then coming to the next question. Sum number 9. In under the self-learning questions, sum number 9. Ascertain the compound interest of 60,000 at 6% compounded semi-annually for 5 years. How much is the principal? 60,000. What is the rate? 6%. If I have to represent it as a decimal, it is 0.06. How much is the period? 5 years. Compounded semi-annually, which means MS2. Substitute in the formula. What is the question? Ascertain the compound interest. First find the maturity value. How do you find it? A is equal to P into 1 plus R by M to the power of Mn. It is 60,000 into 1 plus 0.06 divided by 2. Please be very careful. The M is not complete division. The M is 1 plus 0.06 divided by 2. The division by 2 is only for R, not for 1. What is your question? There is always a question mark popping up. Is that an important question when I am explaining in the class? I told you if you have any doubts apart from what I'm explaining on the screen, please reserve it until 11:30 and ask me after that. So how much is this? Principal is 60,000 into 1 plus 0.06 divide by 2, the whole to the power of 2 into 5. So it is 1.03 to the power of 10. That is how you get this value. But what is the question? The question is, how do you find the compound interest? Ascertain the compound interest. How do you find the compound interest? It is the maturity value minus the principal. So 20,635 will be the amount of compound interest. Is this sum clear to all of you? Is this sum clear to all of you? Fine. That's all with time value of money.